ZZ Top style, maybe. Who knows?
Hey guys, we are on the Red Room for Phoenix RIA. We also are on Luke and I's Facebook pages and the Viking Brothers YouTube channel and the Just for Flips YouTube channel. We have Devin Burr on Mr Brrr to talk about being your own bank, but just a little update. The inventory is just trickling up. Last week's show, we had we were talking a little bit about just how I've got 3 sitting on the market. I've been lowering; they're not moving. We had Templeton Walker. He talked about he has 3 or 4 listings on there, kind of stale, not doing a whole lot of movement. Inventory just keeps going up, so it's definitely a tough time for the real estate market now. The 10-year is ticking downwards. We're talking about, some negotiations are going on tariffs, so maybe the end of the world isn't coming, but it's definitely slow in the real estate industry for sure. So, yeah. But that being said, let's jump into being your own bank. So, Devin, we've known each other. We actually met at the Starbucks. We met at the Starbucks right down the street. I walked down the street to the same Starbucks and got my my afternoon coffee. But I love Devin's model because you can actually, and I'll let him explain it better. I'm going to butcher it here, but you can create a life insurance policy, put money into that policy, borrow against that policy, and go do cool stuff investing in real estate. But I'll let you explain it better.
Yeah, basically what it is, it's just borrowing against an asset. We all know real estate as an asset. So as you build equity in real estate, you can borrow against that. You're using the property as collateral to get a loan from the bank.
Right.
You're using OPM, other people's money. So you're using their money and you're just using your collateral, your asset, as the collateral to get the loan. It's the same thing. So when you buy a life insurance policy, your money that you put in is the collateral, the house.
Yeah.
And then you're building equity in that house. So if you put in $100,000, let's say, immediately within the first 30 days, you can borrow against that up to 90%. Has to be structured that way. That's the really important thing is most agents, 1, they don't know how to structure it that way. 2, they don't want to because it lowers their commission by 40 to 90%. So the agent's very important. You borrow against that immediately and you never have to pay back the loan. That's the beautiful thing. Think about real estate. When you borrow against real estate, you have terms in place. You have a set payment. You have interest. You have principal. You have to pay. If not, then your credit gets dinged. If you miss enough payments, they can take the collateral, the house. With a policy, the insurance company knows you're gonna die. Newsflash, we all die.
Right.
So they know it's an inevitable event that's going to happen. They just don't know when. So let's say, hypothetically, you have $1 million death benefit and you have equity cash value that you can use of $100,000. If you use that $100,000 and you never pay it back, when you pass away, they'll just pay your family the difference, $900,000. So they're going to get their money back eventually. So you never have to pay the loan. That's the beautiful thing. It keeps you in total control of this asset. Put money in, it's guaranteed to grow, 100% tax-free, guaranteed. So think about a house that if you bought the house and every single year, it's guaranteed to go up in value. It'd be the best thing ever. We all know that houses go up, they go down. There's market crashes, what have you. With life insurance, it's been around since the 1700s, and they know how to make money. They're very calculated. Think about what an insurance company is. They calculate risk. So all they do is they know how to grow money at a very steady Eddie pace. If you buy a life insurance contract, it's not going to be a great investment because it's not an investment. You can never lose money. It's It's going to keep
Right.
going up every single year, guaranteed, tax-free. And then you just borrow against it. Whatever you do with that borrowed money, it's up to you. I put it into real estate deals. So now I'm making money in the real estate deal, and I'm making money guaranteed tax-free every single year on a compounding rate. So over time, it gets to be really, really ridiculous. So that's kind of the cliff notes of what it is.
All right. So what does that look like on the appreciation of the asset? Is that like a 3, a 4, a 5? Is there a number over the last 10 years?
Great question. So with the companies that I use, and just so full disclosure, I started off as a client using this in my real estate business. I saw the power of it. I started telling everybody. I grew a big following on social media, and then everyone started asking me how to get a policy. So I figured, why don't I just be the guy that sets it up? So
Right.
I'm a broker. I'm licensed in all 50 states. The companies that we use, the main one is a guaranteed rate of 3.25. It'll never go below 3.25. And that is tax-free. So that's kind of like if you made 5 to 6% pre-tax.
Right.
And then you get a dividend every single year based on how profitable the insurance company is. These insurance companies have been profitable every single year since before the Civil War. So even during that time when everyone's trying to kill each other, these companies are still profitable. They were profitable through the Great Recession, the Great Depression, World War I, World War II, meltdown of 08, swine flu, bird flu, you name it, they are profitable. So what that means, it's a mutually owned company. If you guys have policies, you're a part owner of that company. So when they're profitable, they share those profits in the form of a dividend. With the dividend, it comes out to about 5 to 6% growth, tax-free. So it's kind of like you're making, let's say, 7 to 8 pre-tax.
Right. But if you take that, let's use the example of the $100,000, and you took that $90,000 and you went and did a fix and flip, and you could very well take $90,000, get the down payment, borrow some hard money, use it for some rehab. And let's just say you didn't do great. You made 20 on the 90 grand and you did it twice every 6 months. So 40, you made another, call it 40% return on the cash.
Yeah. So let's say with the cash, you made a 40% return, but in the policy, you made, let's say, a 6% return.
Right.
So that's a 46% return, right? Easy math. Here's the cool thing. You're not using your money. Remember, you're using OPM. You're using the insurance company's money. Your 100 grand is sitting as collateral. It's like it's sitting in a savings account. So you're borrowing the insurance company's money at an interest rate, generally about 5%. So what you just did is you took 5%. That's your control cost to control the 90 grand. You took 5% and turned it into 46%. That's 41% net, which is 800% cash on cash return. Just by putting the money in the policy first, instead of first putting it into the real estate deal. Hopefully that made sense.
Yeah. And so what on 100 grand, let's just say we talked about this before offline that I got a term policy and I might consider this. Would 100 grand buy me $1 million policy, or what would I have to put in to say get my current term policy is $1 million? What would I have to put in to get to $1 million policy if I wanted to replace that? Because I think that expires next year or the year after. So you're thinking of it like most people. You're thinking of it as like, what do I got to put in to get this death benefit? We think about it backwards. We think, how much can you put in? How much do you want to use as like a banking system? And then the death benefit takes care of itself. So like, I don't know what you would get because you'd have to go through underwriting. It's based on your age, all that kind of stuff. So think of it as your death benefit's kind of the cherry on top. That's not what we're structuring the policy for. I always tell people it's life insurance, not death insurance. Right.
So you want to think of it as, what can I use right now? How much can I put in and use? Here's a great example. I put in over $700,000 a year into these policies. So that's like how much I can put in. As I make more money, I put more money in. But because I'm putting so much in, as a byproduct of that, I've got more than enough death benefit. If I passed away today, my family gets $50 million tax free. But I didn't focus on the death benefit. I focused on flowing more money here because it's guaranteed to grow, and then use it to go buy more assets. So if I passed away, my family gets all this $50 million tax free, but they also get all the assets that I'm buying with the cash value.
Right. So I just went. That's why Tracy's here. What do you think?
Yeah. So I had a question for anyone that's listening. If someone has options between an IRA or cash on hand or just different ways that they can invest in real estate, what's the avatar of someone listening that this could apply to, where it's like, why don't you look at this as a channel or as a platform to be able to invest that money? Give us an idea of like your average customer, or when in their investing journey this would really make sense for someone to start using.
I think honestly it makes sense for anyone because everyone gets money somehow, whether it's a W-2, whether it's through investments, whether it's through dividends because you're getting interest on those investments. Everyone has money coming to them. Most people, where does their money go first before anything? To the bank, right? Chase, Wells Fargo, where have you. As soon as it goes to the bank, what does the bank do with it?
Lend it out.
They lend it out. So who's in control of your money? The bank, right? So if you put your money in the bank, you're getting 0.06% on average. The bank is taking it and making 5, 6, 7%. So they're making an arbitrage on your money and just paying you a little bit to hold it there.
Right.
And it's not protected. So if anyone tries to sue you and you've got hundreds of thousands in the bank, millions in the bank, they can take that on a judgment or lawsuit. So I think this makes sense for anyone because everyone's money has to flow somewhere. And the more it moves, the velocity of money, the more it moves, the more it grows. So what does a bank do? A bank gets your deposits and they move it. Someone uses that money, it comes back to the bank. Bank gets it, they move it again. So the bank is constantly moving money. They understand the velocity of money. Yet we've been taught to put money in the bank and let it sit, put money into a 401k, let it sit and hope it's enough for retirement. We've been taught to let money sit, yet no company and no bank lets money sit. So if your money has to flow somewhere, this is a better place for it to flow. It's going to grow at 5 to 6% tax-free, way more than any bank. It's going to be protected against lawsuits and judgments. So if you've got millions of dollars in there, no one can touch it. It's going to give your family a death benefit, which is a multiple of what you've put in. If you've got money in the bank, your family's just going to get that after, the government gets their hands on it. This is a private contract. So nobody has access to it but you and your family. And the beautiful thing about it is that this has been used by the wealthiest families throughout history, the Rockefellers, the Rothschilds. They understand something that most people don't. They know how to protect and multiply and perpetuate wealth. It's just most people look at this and they think, oh, whole life, Dave Ramsey and Susie Orman said it's a scam, so it must be. They don't know what they don't know.
Yeah. So on the growth, it's non-tax, but on the money going in, is that after-tax dollars?
Great question. So there's ways around that. I'm not a CPA, so I don't want to get into all that. Obviously, I have a tax professional that helps me with it. But one way that I know for sure is you can pay your kids from, I believe, age 7 to 17. I pay my daughter every single year. It's like 13 grand I can pay her. It comes off my taxable income. She doesn't get taxed on it. So I pay her that, and then we take that and fund policies that are on her. I'm the owner, but they're on her. So that's a way to get like tax-free dollars into a tax-free environment. There's also ways if like your trust owns it, and you pay the premiums through trust dollars, that's taking taxation off that trust. So if your trust made $1 million, you fund 300 grand into policies. Now you're only at a $700,000 tax liability on the trust. Gotcha. So those are the ways that I know of, but for the most part, it's with post-tax dollars.
Okay. That's awesome. So like you said, I mean, obviously you're putting a lot of money in this stuff and it's your kind of your main business, but like, I mean, we all, like, I guess that I'd answer my own question. I mean, you're putting 100% of your daughter's money into this as, now and then she can even probably borrow against that for college funds and all that kind of stuff too. First car, all that, right?
That's how we bought her first car. Yeah. So she's 18 this year, which is crazy. And when she was 16, we had enough money in her policy because she had been having a policy since she was 14. There was enough in there to buy her first car. So we went to the dealership. We did the whole song and dance with the salesman. Like, he slides the paper across. Here's the payment. And then I was like, no, I want it to be this. I want it to be that. Takes it back to the manager. You guys have all bought cars.
Then he pulls you up on TikTok and sees who you are.
Well, once we decided on a payment that my daughter could afford, my daughter pays the payment. Once we decided on that payment, I said, okay, cool. We're going to pay cash. Salesman looked at me like, what do you mean you're going to pay cash? Why did you do the whole figuring out what the payments would be? I just simply told him, I want to know what we're going to pay our bank back. If you buy from a bank, you have to pay them on time, principal, and interest. So if we borrow from our bank, our banking system, wouldn't it make sense to pay ourselves what we would have paid them? So that's what we're doing with her car is we're borrowing against the policy. That money's still growing and compounding. And now we're just paying back what we would have otherwise paid to the bank. So we're getting all the money back for the car, plus the interest we would have paid to the bank. And the whole time the policy is growing. So I think the loan is for 5 years. We get every penny back for that car. We actually make a little bit of money buying it because the net injection into the policy is less than the growth of the policy over those 5 years. Really cool. And I'm teaching my daughter this so she can actually do it in her life. She'll never have to borrow from banks for college, for her house. She'll never lose money to banks, really. That's the beautiful thing.
So Devin, with the thresholds that you're talking about, you had mentioned 700,000. Chris is mentioning 100,000. For any investors that are listening or future investors that are saying, hey, I don't have $1 million laying around, is there a certain benchmark to where you would say, hey, this makes sense regardless of if you have 5,000 or $500,000 or 5 million? Is that something that you talk to your clients about, or is there a threshold to where you say, hey, you should really think about infinite banking at 100K?
Great question. I mean, I think the more you put in, the better, obviously, because then that's more you can use. It's more that's growing, and you can use it right away if you're putting a large sum in. If you don't have a large sum, which some people don't, right? There's a lot of people out there that are just paycheck to paycheck. So for that situation, I just tell people you can start this and with a smaller amount, like a monthly amount of whatever. I make sure they know that it's going to take a while to build up that equity in order to use it. If you're only putting in $300-400 a month, there's not much you can use, even if you can use 90% of it. If you put in $300, what's that? 280 that you can use. So it's not a lot. And I just let people know it's going to take time to build up that stockpile of money to start using it to pay debt off, to buy cars, to do investments, and that kind of thing.
Definitely want to learn that trust thing, because obviously I put all my stuff in the trust. So if there's a way to, decrease the taxes and put it in, that obviously definitely have to reach out to my accountant on that one.
Yeah, I would definitely ask. I think it's a certain kind of trust you have to have. There's so many different trusts.
Yeah.
So I would ask him and see if you can do that. If you can have life insurance premiums paid by the trust, if it becomes an expense of the trust. And if so, then that's a way to get that money in there, not to pay taxes.
So in that 5%, let's just use that as an example. Back to the $100,000, we borrowed 90% of the money. That's 90 grand. 5% interest. That's $4,500 bucks a year. Call it 400 for round numbers monthly. Does the insurance company send us a bill like, here's your monthly payment, or how do we pay that 5%?
That's a good question.
Again, yeah, They never ask for a payment. They'll never send you a bill saying you have to pay this amount because they know you're gonna die, and if you don't pay it back, they'll get it then.
Okay, gotcha.
So, and here's
So-
the cool thing is they don't want you to die soon. They want you
Right.
to live a really, really long time because if you die soon, they have to pay the death benefit.
Right.
So they want you to live a long, long time. You're in partnership with a company because you're a part owner that wants you to live a long time. They want to protect your money against taxes, and they want to be profitable every single year so they can share those profits with you. So
Right.
you never have to make the payment. You should, you just never have to.
Yeah, it makes sense. But you could literally borrow that 90 grand, keep flipping houses, and never technically. I mean, I'm the type of guy to be like, all right, this property I made 20 grand on, whatever, 2 grand was the interest expense on the 5% on the money, send it back. Here's the profit left over. Now, and that's another question. Do you have to put the money back that was made from the 90 grand back into, or is that just
Nope.
your money?
Like I said, you're in total control.
Okay.
This is one of those vehicles where you literally have unhindered control. You have total control of it. So you can make it as good or as bad as you want. I will tell you that if you're not paying money back into the policy, if you're not paying the interest, the policy is just not going to perform as well.
Right.
Because what happens is if you don't pay that interest back, it gets tacked onto the balance. And now you have a compounding loan. That you don't want that. It's a simple interest loan. So if you take 100 grand out and you pay 20 grand back, now you only have 80,000 or accumulating interest.
Right.
So what I do is I flow everything I make, all of my income to pay down policy loans. As soon as I do that, the money is there available again. Think of it like a line of credit.
Right.
If you pay that line of credit down, that money is available to use again. So I'm always paying my loans down. So I'm accruing less daily interest. And then when I have an opportunity come up, I have a stockpiled amount of cash in these policies that I can deploy into something that I know, like, and understand, so that I hedge my risk against losing it outside the policy.
Right. That makes sense.
So to Chris's question, if you make the 20K on the 90K that you've lent yourself and you put it back into your policy, are you waiting to pay taxes on that, or is that considered taxable income if you don't put it back into the policy?
Say that one more time.
So the profits that you make out of the money that you lend yourself, when do you pay taxes on that?
So that is just like whenever you would normally pay taxes on it. All right. So if you file an extension and you have till October, or if you do your taxes early, if you're doing like a quarterly pay in, that's all just normal. So anything you do with the money outside the policy is open to taxation. Any kind of growth inside the policy, there's zero taxation, guaranteed for the rest of your life.
So if you put the 20K that you made in profit back into the policy, is that under the provision of it's part of the policy? Like, do you wait to pay taxes on it since you're putting it back into the policy? I don't know if I'm asking that correctly.
Okay, so I see what you're looking at as the same thing. You've got premiums, so that's what you're paying into the policy. That's what's growing and compounding tax-free. And then you've got loan repayments. These are two separate things. So if you took a loan out for 100 grand and you paid back 20 grand, that's a loan repayment. That's not more premium.
Well, I'm saying if he ends up making so, you lend yourself the 90K and then to his same example, you're making 20K off of that. I'm saying if you don't pay yourself a profit and you just up your premiums, I guess that's if I'm using the right word, and it just goes back towards the policy, is that still under the umbrella of, I guess I'm wondering about that taxation if you just put any of your profits back into your policy and then lend even more to yourself.
Got it. So as soon as you pay back what you took out, so you've got your premiums, right? You borrow against them, you go make a profit. Let's say you took 100 grand out and you made a 50% profit. So you got 150 back, right? Mm-hmm. You can't put 150 into this policy or it'd be too much premium because you'd pay back the entire loan and you'd have a 50,000 surplus. If you put that surplus in, it would cause this policy to become a taxable event. You don't want that. So what I've done, and this is why I have 15 life insurance policies. As I make more money and I do what I just said, where I pay back all of the policy loan, but I've got a surplus from profit,
Right.
I start another policy. Does that make sense?
It does. And thank you for answering my question specifically. If I wasn't concise enough the first time around, I was wondering what happens to that profit when, like, how you appropriate it within or outside of the policy.
Yeah, you just start another policy, or if your premiums are coming due. So let's say you used a policy loan and you didn't get a return for like 11 months in a real estate deal. You've got premiums due on this policy in about a month. So then you just wait with that profit to put it in for more premium. But if you make a profit in like 2 months in a deal, you don't want to hold on to that money in your bank for 10 months. So that's when you start a new policy.
Gotcha. So when you talk about premiums coming due, let's just say I put $100,000 in now. Would I need to put $100,000 in next year, $100,000 in next year, or is that structured at the beginning? I'd say, okay, Chris, I don't want to put $100,000 because I'm going to put in 50 for the next 10 years type of thing.
Right. You structure it up front. So you would tell our team, hey, I can put in $100,000 this year, but I don't think I can do that every year. I think I can do $20,000 a year. I think I can do 30, 40. And the beautiful thing is what you're doing is you're choosing your ceiling up front. So let's say you say $100,000 this year and $20,000 the following years. $20,000 is your ceiling. You can't put in more than that or it becomes taxable. You can put in less though.
Gotcha.
So if you choose $20,000 and then next year comes around, you just don't have $20,000, you've only got 10, put in 10 because you didn't go over the ceiling. You can catch it up later. So if you only put in 10, you fell behind by $10,000. That's $10,000 that's not compounding in the policy. Once you have a windfall of capital, you can catch it up.
Gotcha. Okay. That makes sense.
So there's definitely flexibility, and it's all about how you structure it. And that's why it makes sense to work with agents that know what the heck they're doing. And all of my agents have policies like this. We will not bring anyone on that does not use this concept and know it inside and out.
Yeah. Like the fix and flippers that funded in 2021, they had $100,000 because they were making more than they could even think about. And then 2022, 2023, 2024, they're like, I could only do 30 this year, 30 this year, 30. Now 2026 comes and it's like a banner year again. They can drop in, they can catch all that up. They can go, oh, I got 70 from this year, 70 from that year, 70 from that year.
Yep. And then all that money is now protected against lawsuits and judgments. And then what it does is every time think of it as like if $20,000 is your ceiling, there's a minimum that's probably about 30% of that. So that would be about $6,000.
Yeah.
So as long as you're putting in $6,000, you're good. So you could put in $6,000 every year. You're falling behind. The difference between 6 and 20 is overfunding. You're overfunding whole life insurance. That's what gets you cash value. When you do that, when you overfund it, it gets you a whole bunch of cash value you can use, and it gets you a little bit of death benefit. So if you fall behind and you dump all this money in to get you all this cash value to catch up, you're getting a bunch of cash value. It's protected against lawsuits and judgments, but you're also boosting your death benefit at that time too. So if you did that and then the next day, God forbid you pass away, your family's getting a whole bunch more money tax-free from the death benefit.
Gotcha. Yeah. That's awesome. Cool. Well, we appreciate you jumping on. I know, I had 80 or 90% of it covered. There's a couple little things that I got to ask this time that I didn't have covered, but I think it's a fascinating structure. Like you said, if you got some extra cash laying around, you could drop $100,000 in, pull out 90%, and then go start your next fix and flip the next day. And like I said, a normal fix and flip, your cash on cash is generally, in the 20s, 30s, 40s. So.
And Devin, this is a really complicated subject. I was not at the 80 or 90%. I'll profess that. So thank you for explaining to me a little bit more. But your popularity on social media, I think, I mean, tell us, has that been in part because more people need to know about this and thought it may be because of the old influencers gave it a bad rap? And then how do people find you online so they can learn more about this and connect with you?
I think when I got onto social media, it was like end of 2020, and it was like just perfect timing because everyone's at their house. It's during COVID. Everyone's like scrolling on their phones. And this wasn't something that was really talked about. People didn't really hear about infinite banking. So I started talking about it. And then a lot of people just don't understand it. So it's kind of controversial. So you get a lot of people hating on it. And I had a bunch of time too because I was stuck in my house. So I would literally just poke people. I'd poke the haters. And the algorithm loved it because then the haters would just keep going back and forth with me. They'd be like, oh, you're an idiot. Oh, well, why am I an idiot? Oh, because da, 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 da. And I'm like, oh, tell me more. I don't understand. I would literally poke the hell out of them. And the algorithm loved it. So I had videos that like blew up and had millions of views.
Yeah.
And I'm a firm believer that people watching this, anyone that watches this, some people, you're not going to like me for whatever reason. Some of you are going to love me. It's just the way we are as humans. Like you're going to have your tribe, people that really just love you. They're going to have people that just can't stand the way you even talk. So the algorithm pushing out to so many people, I captured a bunch of people that vibed with me. They were like, dude, I really like this guy. I feel like I can trust him, blah, blah, blah. And then I started posting more about my family, and I would get on calls with people and they're like, hey, how's Haley? That's my older daughter. I'm like, how do you know Haley? Or on your story. I'm like, oh yeah. So like, people started trusting me because they felt like they knew me. And it was just cool. It built at the right time. I've built everything off of just organic growth, putting videos out there. And it's not a sexy topic. Like no one's like, I want to be a life insurance agent because it's really cool and sexy. It's just, I used it in my own life as a real estate investor, and I saw the power of it. I think inherently as humans, when we learn something that has value, we want to give it to other people, even if it's something that makes us laugh. If we find something funny, we want to share that with other people. So I learned something that helped me. I wanted to share it with others. And I think that came across. At first, I wasn't selling policies. I was just sharing what was working for me.
Right.
Yeah.
I think that came across to people like, this dude's not trying to sell me anything. He's just trying to teach me something that's working for him. And then I just figured, why don't I actually be the guy that sets them up? So if you guys want to find me on social media, it's Mr_Brrr. That's B followed by 4 R's. That's on TikTok, Instagram, and also YouTube. You can check out all the content there. I've got a ton of it. And if you are interested in getting a policy or just learning more, there's a link in my bio titled Infinite Banking. I've got an in-depth video that really goes into examples and kind of paints the picture of how this really works in your life.
That's awesome. We appreciate it. I think you got to run and go pick up your daughter, but we appreciate you spending the time with us, and hopefully someone jumps on. Like 400 to 500 people watch these videos over time. So hopefully you get some customers out of it, because I'm probably going to be your customer next year myself. So
there you go.
All right. Well, you guys have my number. If you guys have any questions, just text me. I mean, I love talking about this stuff. Again, it's not sexy, but I love talking about it because I know the power of it. So just let me know how I can help you guys and serve you.
Appreciate
it.
All right, guys. See you later.
All right, Burr. We'll see ya.
Bye.